Right. So I think indeed the Fed is putting a lot of importance on the labor market. The problem with the labor market is that it is a lagging indicator. So usually it's the last bastion or last domino to fall when the others have already fallen. So I think that's the problem with being, backward looking versus forward looking. If you look at the forward looking indicators, they're all suggesting some slowdown in the U.S. economy. And I think, at some stage, the labor market will also slow down. And I'm looking for a slowdown in employment towards year's end, potentially early next year. And by that stage, I think the Fed will indeed stop the rate hikes. If it's not the case, and if the labor market is more resilient than expected, then the Fed will probably carry on hiking interest rates in 2023.
Yeah, you make note of how 100 basis points would probably exceed the Fed's sort of boundaries. But if you're fighting this beast of inflation and you say you want to do it at whatever cost, I mean, what's the difference then? 75 basis points, 100 basis points? You might as well go all in and front load these hikes, and then you'll kind of deal with the ramifications later. Is that not the sentiment perhaps that should be put forward?
Right. So the Federal Reserve tends to be careful when it delivers its decisions. The market is pricing roughly at 75 basis points. I think the Fed will deliver on that. I think the Fed will want to steady the boat. They've been already very hawkish, including at the Jackson Hole summit. I think the priority is clear. They want to fight inflation, but I think 75 basis points would deliver on that goal. I will also remind you that it would be the third rate hike of 75 basis points. And you need to actually go back to 1981 to see such a violent tightening of monetary policy in the U.S. I mean, if you look at the past 6 months, the amount of tightening that we are going to get, that's just enormous. So I think the Fed is tackling inflation. And now I think actually the risk is potentially the risk of over tightening is bigger than the risk of underdoing it.
Well, Thomas, on that note, how long is the lag between the Fed raising interest rates and the observable impact in the real economy? Given that you just said that the risk of over tightening is greater than the risk of under tightening, would suggest to me that perhaps that lag is just a little bit longer, making the Fed's job even more difficult.
There is a long lag, and it was interesting to see that the Fed mentioned the lags at the July meeting, but since then they've been no longer mentioning those lags, and it will be interesting to see whether this argument about lags come back at today's meeting. But there are definitely lags of around at minimum 6 months, probably more closer to 9 months, but up to 12 months in terms of the tightening impacts on the economy. So we are only going to see, slowing employment, slowing inflation as well, only by year's end. And so, the risk is that by then, if the Fed continues to be backward looking and looking at the actual data rather than the projections or economic models, that it could actually overdo the tightening.